So let's talk about some of these sources of money again. And, we start looking at these different markets. We have what we consider the primary mortgage market, and then there's also the secondary mortgage market. Here's how to determine the difference between the two. Pretty simple. The primary mortgage market is anywhere you would go to borrow money. Anybody loaning money, any lender. It would be a bank, savings and loan, credit union. Even mortgage brokers would fall under the primary mortgage market. So basically, anywhere you would go get money, borrow money rather, that's considered your primary mortgage market. But the primary market really cannot exist without the secondary market. Well, who is that? Well, the secondary market is Fannie Mae, Freddie Mac, Ginnie Mae, Sally Mae, and so forth. In essence, it's the government, okay? But it says here that it consists of entities that buy back loans from the primary market. That's what they do. They buy back loans. So if you think about it, if you have a bank, obviously being in the primary market, believe it or not, banks don't have some endless pot of money that they can just loan out as much as they want to. Eventually they can only loan so much before they will run out of money. So what they have to do in order to keep loaning money, that's what they're in business to do. They have to sell these loans, and they typically sell them back to the secondary market. Well, the secondary market may have some say-so on what types of loans they're going to buy back. So the secondary market might say, all right, primary market, you loan the money, and then we'll buy the loan back from you. That replenishes the money, so now they can go back and make more loans. That's just what keeps the money circulating. But the secondary market will also determine the criteria of the loan if they're going to buy it back. And so in essence, what the secondary market is saying is this: if you make a loan and it conforms with our guidelines, our requirements to loan money, then we'll buy the loan back from you. Now, you notice I use the term if the loan conforms to their criteria. That's where we come up, or sometimes you hear about conforming loans. If it's a conforming loan, it means it meets the secondary market's criteria. If it doesn't meet their criteria, then it's considered a non-conforming loan, and I promise you're not going to like the deal you get on those loans. Those are going to be even more expensive loans. But anyway, so the primary market, they're the ones who basically determine the credit score or the range or whatever. They determine what your debt to income ratio is. In fact, if you remember earlier, a couple hours ago, we talked about how to qualify the buyer or the borrower and the ratios involved for different types of loans. That comes from the secondary market. They determine what those will be. Now, if the primary market makes a loan and it is not a conforming loan, and they will do that, that's pretty much all the banks do it. That's part of their portfolio. But any non-conforming loans they make, they're stuck with those loans for the most part because they can't sell it back to the secondary market. So they're going to have to honor that loan for the life of the loan. And again, pretty much all banks will do some of that, but they are limited on how much of it they can do. Again, because otherwise they'll just run out of money. So that's how these two markets work. I don't think you're going to need to worry about what types of loans Fannie Mae buys back or Ginnie Mae or whatever. You can read it there in your material. I don't think they're going to be asking stuff like that on the exam, but I guess they could. Fannie Mae, for example, they buy back FHA loans. Sallie Mae, I'm sure a lot of you, unfortunately, I know we're familiar with Sallie Mae. Y'all, they buy back the education loans, student loans. Yeah, there you go. And so forth. But anyway, y'all, that's how those two markets work. Well, now we want to kind of move into some different types of government loans. And this is, y'all, these are different than the conventional loans. Well, the first government loan we're going to look at is the FHA insured mortgage loan. Now, obviously, it's called FHA insured loan because it is government insured. That's why it's called government insured loans. Now, but here's where you want to really be careful, because there is a big difference between, say, FHA and conventional. With FHA, it is government insured, which means there will be mortgage insurance. You know, we talked about that with the conventional, but this one's a little bit different. You will have to pay mortgage insurance if and when you get an FHA loan. Now, is there any amount of equity you can build or obtain and be able to get rid of the mortgage insurance? Not with FHA. Y'all, because y'all, with FHA, you're paying mortgage insurance premiums. Y'all, that's MIP. If you recall, with the conventional loans we talked about earlier, for those that borrow more than 80%, then you're paying mortgage insurance, but that's private mortgage insurance. Y'all, PMI. Y'all, you don't get those confused. Y'all, PMI is paid with conventional loans. MIP, mortgage insurance premiums, is paid on government loans, okay? And you will have to pay mortgage insurance for the life of the loan. Now, there is that 3.5% down payment requirement. Remember, the loan-to-value ratio is 96.5%. But one of the good things about the FHA loan, you'll notice there is no prepayment penalty. Y'all, in fact, we're going to look at, I don't know if we'll get into it this hour. We might, but if we don't, certainly the next hour, y'all, we're going to be looking at some of the provisions, more common, typical provisions you would find in a mortgage, okay, the legal requirements. And y'all, occasionally you'll have, depending on the type of loan, y'all, a lot of times lenders will actually put what they call a prepayment penalty in the mortgage. Y'all, and it's exactly what it sounds like. If you pay the loan off early, y'all, even if you get a 30-year loan and you pay it off one day early, you're going to get hit with a penalty. You know, and it's typically several thousands of dollars here. Y'all, what a scam. That's a ripoff. Are you kidding me? I got to pay several thousands of dollars in penalties if I pay the loan off early? But anyway, y'all, with an FHA loan, lenders cannot charge a prepayment penalty. So that's a positive for FHA. But one thing, or the last thing you certainly need to pay attention to here, and y'all, because apparently they like to ask this question on the exam. And you might get a question like, where would you go to get an FHA loan? Well, obviously, one of the answers they're going to be providing you is the FHA. Y'all, doesn't that seem a little bit, that just seems like that's too simple, doesn't it? Yeah, and it is. Don't fall for that. Y'all, the FHA does not loan money. So you cannot go to the FHA to get a loan. So don't fall for that one. Where do you go to get an FHA loan? Y'all, do not pick FHA. Y'all, lenders loan money. So the answer you need to be looking for there, if you get that question, will be a lending institution authorized to loan or do FHA loans. Okay, but at the end of the day, lenders. Y'all, the FHA insures the loan. They do not actually make the loan. They just insure it, in case there's a problem with it. But y'all, this is the FHA insured loan. Y'all, and I will tell you, this is a very expensive loan. Y'all, primarily because of that mortgage insurance, and you're stuck with it for the life of the loan. Y'all, at least with conventional, y'all, you can pay it, build up enough equity, you can get rid of it and not have to pay all that expensive insurance. But y'all, a lot of people there are getting FHA, and the main reason for it is because it requires the least amount of down payment. All right, moving on. The next government loan is the VA loan. Y'all, in fact, now you notice this is not a government insured loan. Rather, this is a government guaranteed loan. So the government, y'all, there's no mortgage insurance with this loan because it's not insured. Rather, it is guaranteed. Y'all, it says first of all, can anybody apply for a VA loan? Well, obviously, no, you cannot. You have to have what they call it a COE, or Certificate of Eligibility. You got to be a veteran. If you are or have been a veteran, then you should have a Certificate of Eligibility, and you could apply for a VA loan. Now, having said that, can anybody assume a VA loan? And y'all, for test purposes, make sure you don't get this confused, but the answer is yes. So only a veteran can apply for a VA loan, but anybody can assume a VA loan. Now, if you're not sure what we're talking about, y'all, with this assumption, y'all doing a loan assumption, we're going to be talking about that a little bit more here in a little bit, but I will just tell you, for example, y'all say, I am a veteran. If I have a VA loan on my house and someone just wanted to assume the loan, basically just take over the payments. And I will tell you, VA loans are assumable. In fact, most government loans are probably assumable loans. Meaning the buyer may not have to go get a new loan to buy the property. They could just assume the one the seller currently has, taking over the payments and so forth. All this has to be approved through the bank. You just can't make that decision on your own. But my point is, if I have a VA loan, can somebody that's not a veteran deciding to buy my house, could they just assume the loan that I have? Yes. Y'all assume it's all approved and everybody qualifies, then they can. But I remember that. That's probably testable. Again, only veterans can apply for a VA loan. But once they get the loan, then anybody can assume that loan if the veteran allows them to do that. But y'all, VA typically comes with 100% financing. I say typically. Y'all, they offer 100% financing, meaning no down payment. But I got to tell you, that's a little bit, y'all, we need to talk about that, and we are going to talk about that here in just a second, because, y'all, it's not unusual for the buyer, even with VA financing, to still have to pull money out of their pocket in order to close, and we're going to talk about why that is here in a little bit. But the last thing you see here, y'all, again, because this is a government loan, y'all, lenders cannot charge a prepayment penalty. All right? Y'all, they like to ask these questions. Which of the following loans would or maybe may not allow a prepayment penalty? So we know FHA, no prepayment. In fact, pretty much any government loan, no prepayment penalties for government loans. You should see a section, dealing with restoring eligibility. And what they're talking about is this. If I'm a veteran, I can only get so many VA loans. I can only get approved up to a certain amount. I'm just making up a number right here. But say I'm approved for $300,000 in for a VA loan. Well, I borrow $300,000 to buy the house. And then maybe I've got $75,000 in equity already built, which means I have paid, or I still owe $225,000. Well, that means at that moment, I only have $75,000 worth of equity or eligibility left. Y'all, I can only spend whatever my limit, or I say spend, borrow whatever my limit is, okay? And that limit's not going to change. Where the veteran could have a problem is if they go to sell the house. Now, obviously, if they sell it, that pays off the loan. Y'all, that totally restores all their eligibility. Now I've got a full $300,000 worth of eligibility again. Y'all, again, I'm just making up that number. It could be more, it probably will be, or less. Y'all, it depends on what you qualify for. But where the issue could come in is if I did allow someone else to assume my loan. Now, if they assume my loan, y'all, then I'm losing my eligibility as a veteran to get another VA loan. So that's something you better be careful of if it's a veteran. If it's a VA loan, if you're representing seller, you better make sure they know this. Because I will tell you, loan assumptions you're going to see coming back, they already are. Y'all are going to be a huge deal over the next several years. And the reason for it is because, if I go get a loan today, I'm looking at 7% interest. And that's if I got good credit. But the current homeowner that's selling the property, they have a loan on the house still, but they're only paying 3% interest. Well, good grief. Y'all, would I rather assume their loan at 3% or go get another loan at 7%? Y'all, that's a no-brainer. I'd rather assume your loan. And do it that way. Y'all, we'll talk more about loan assumptions. There's more that goes into it than that, and we'll talk more about that later. But my point is, if you're a veteran and you agree to let someone assume your loan, just know you're losing that eligibility. Until they pay that off, you no longer have any eligibility, or very little eligibility. Okay? So VA works a little bit different here for sure. All right. Y'all, let me back up here a second. Y'all, I hadn't talked about this yet. Y'all, again, still concerning VA loans. Y'all, and this is something, you certainly want to be careful with. Anyway, let me just sort of describe to you what you need to understand. Obviously, the VA is going to require an appraisal to be done. And what you'll see a lot with VA financing. Let's say this house is under contract for $300,000. And it would appraise for that all day long. It's worth $300,000, and that's what it's under contract for. Don't be shocked. In fact, I'd be shocked if this didn't happen more so than the other way. But don't be shocked when that appraisal comes back something just less than the contract price. In this case, $300,000. For example, it might come back at $295,000. Something just under the contract price of $300,000. Well, if that happens, and by the way, the VA does not even call it an appraisal. They call it a certificate of value. It's just a government appraisal is all it is. Remember, the VA says they will loan you 100%. The loan to value is 100%. But 100% of what? It's not necessarily based on the purchase price. It's based on the certificate of value, that the appraisal. Not what you got it under contract for, what it appraises for. So if the appraisal comes back at $295,000, that's all the VA is going to loan. That's it. Well, but it's under contract for $300,000. Now what? Well, there's a couple of options here. One, the seller potentially could agree to just drop the sales price down to the appraised value, or And by the way, good luck that happening. But if the seller doesn't agree to drop it to whatever that appraisal came back at, then buyer, you're going to have to pay the difference out of pocket. So this, it's not unusual for veterans getting a VA loan to actually have to still pay out of pocket. Now, I will tell you, it does seem, at least to me, it does seem like VA is getting a little bit better with this, and we're not seeing it as much as we used to, meaning it appraises for less than what it's under contract for. But I will just tell you, if the buyer agrees to pay out of pocket, in this example, that $5,000 out of pocket, that money cannot be borrowed and it cannot be given to you. So in essence, when you tell the lender, I'll pay the $5,000 out of pocket, the VA is going to say, where's the money? Obviously, it better be in a bank, in an account somewhere. And then they're going to audit that account. They want to make sure that that money is, in fact, in your account and that it is seasoned. In other words, it didn't just show up there. If they find that a $5,000 deposit was just recently made, or a very large amount of money was just recently made, or deposit was made, then the assumption might be that either somebody has either given you the money to put down or they've loaned you the money. And that's a no-no. They're not going to loan the money in that case. So the money must already be there and it must be seasoned. Now I will tell you, and again, this may have changed. VA keeps changing stuff a lot here and there. But you're looking at roughly 60 days or 60 to 90 days, something like that. If they see that a large sum of money showed up within the last 60 to 90 days, you could have a problem getting this loan. You could. But anyway, that's the VA loan. The next government loan is the USDA loan. Now, these are very popular loans as well. Again, none of these government loans are very cheap. I'm just going to tell you, in case you hadn't figured that out yet. But again, what people like about it, it's 100% financing. No down payment required with a USDA loan. Now, the stipulation with this loan is the property you're buying must be in a rural area. You cannot get this or have this loan on any property. I will tell you, they have, there is a website. I don't know the URL or what the website is right off the top of my head. But there's a website you could go to, type in the address of the property that you're thinking about buying, and it will tell you does the property qualify for USDA financing. Obviously, if it doesn't, then you're not getting a USDA loan. But it has to be in a rural area. If you're looking at a house in downtown, I can tell you it's not going to qualify. You won't be getting this loan. But again, with this loan, you will have to pay mortgage insurance premiums. I'm just telling you that mortgage insurance is what makes things expensive. In fact, if you haven't realized or figured this out yet, if you don't have money to put down, a down payment, this is going to be a very expensive loan for you. Very expensive. It's my opinion, but I'm just going to say it. Save some money. Don't try to buy a house without money. You're going to need money to own a house. Just saying. You're going to need it. So I would try to save up enough for a down payment where I get reasonable, very good terms on a loan for the remaining balance. Otherwise, this is going to be incredibly expensive for you to get this loan. To the point where you'll probably never pay it off. But anyway, moving on. Here's these loan assumptions, we were just kind of making reference to earlier. And again, what is a loan assumption? That's when you, instead of going to the bank and getting a loan to buy a house, you and the seller just agree that you can actually just take over the payments, take over the loan that they currently have already in place. Y'all, some loans, y'all, typically government loans are assumable loans where you can do that. Not all loans. So this is something you'd certainly want to look into before you just decide to do it. You better make sure it's a loan that you can do this with. But y'all, you just assume the loan. But y'all, say for example, you're buying the house for $300,000. But maybe the loan on that house, y'all, because the seller's already been making payments on that loan, right? So they might only owe $225,000. So meaning they got $75,000 in equity. Where you're agreeing to buy the house for $300,000, but the loan amount or the current loan balance on that loan is only $225,000. So that's where's this other $75,000 going to come from? Well, typically, unless you have the money to pay cash to make up the difference, and some people do, but if you don't have the cash, that means you will have to get another loan at least for the $75,000 difference, or whatever that difference would be. And I've had people say, well, Frankie, does it really make sense to assume a loan if I'm going to wind up basically with two different loans that I'm having to make payments on, versus just getting one loan to buy it all outright? Well, would you rather have a $300,000 loan at 7% interest, or would you rather have a $75,000 loan at 7% interest and a $225,000 loan at 3% interest? I believe I'll go with the two loans. It's going to be a whole lot cheaper. Y'all, you add up the two payments you're making on them two loans, it's going to be a lot less than that one payment you're making on a full $300,000 at 7% interest. Okay? So it's typically whatever the rates are doing versus what the current rate the seller has at the time will determine whether an assumption is something to look at or consider. But if you're going to do a loan assumption, y'all, there's a couple of ways to go about this. And you certainly need to be aware of this for test purposes. Y'all, you could do a loan assumption subject to the mortgage. Y'all, it's subject to, you notice in bold and it's underlined. Y'all, that's important. If the buyer and seller agree to the assumption subject to, basically what that means is this. As long as that buyer makes the payments they're supposed to make every month to the bank, then everybody's happy. But if that buyer starts missing payments or just quits paying at all, then guess who the bank's coming after? The seller. So seller, you're still on the hook. You're still liable if that buyer does not make their payments. That's what subject to means. So if I'm the seller, I would not like that at all. In fact, I might say, look, I don't care. You can assume the loan if you want to, but I will have no responsibility or liability as to whether you pay or not. Well, if that's the way you want to go, then we have to look at requesting a novation that you see next here. Basically, you got to tell the lender we want to allow the assumption, but with a novation. Novation just means substitution. It just means something is being substituted for something else. It could be you could substitute one contract for another contract. You might be substituting a person for another person. But novation just means that something's been substituted for something else. So we're requesting a substitution, a novation. And assuming the lender agrees to the novation, then what they've done is they're saying we've allowed the assumption to take place, and we've agreed to take the seller off the mortgage and put the new buyer on it. We're substituting one person for another person. And now, if the buyer now does not make their payments, now the bank's coming after the buyer. Y'all, the seller's off the hook. They're done. They have nothing else to worry about. So just be aware of the two ways to do an assumption, either subject to or with a novation. Okay. Now we get into these, what we consider elements or common provisions you would see in a mortgage. Okay. But before we even get into these provisions, y'all, we need to talk about something here real quick. Y'all, in fact, I would say from this point on, y'all, throughout the rest of the course, you're going to start seeing a lot of terms ending in EE and OR, like mortgagor, mortgagee, grantor, grantee, vendor, vendee, leaseor, lease. Y'all, there's going to be a lot of them. ORs and EEs. Y'all, you've got to make sure you know who is who. You better know who the OR is and who the EE is. Y'all, and right here, what we're talking about, y'all, who is the mortgagor and who is the mortgagee? And I will tell you, and I know why. I feel like I know why this is such a big problem. Y'all, most people get this wrong. Y'all, who is the mortgagor and who is the mortgagee? Who is it? Well, y'all, if this helps you, I will give you this. Maybe you've already heard this before. But if you haven't, y'all, OR is the one that's giving something. EE is the one receiving something. Okay? So here's where we run into a problem. In fact, let me go back to answer the question. Y'all, who is the mortgagor? Y'all, the mortgagor is the one giving. Y'all, that's the borrower. I know someone said, no, that's the lender. The lender should be the mortgagor. The lender's the one giving. No, y'all, here's where people are making their mistake here. First of all, what is a mortgage? It's a lien. It's security for the debt. That's all it is. Unfortunately, what most people are thinking in their brain, and I'm telling you, if you don't pay attention to what I'm telling you right now, you're going to miss this question. Most people think a mortgage is a loan, and it is not. So when we talk about who is the mortgagor, you're talking about who's giving the loan. Well, obviously the lender's giving the loan, but a mortgage is not a loan. That's not what we're talking about here. Yo, you got to get that out of your mind. Mortgage is not a loan. Yo, you'll see this a little bit later, but the loan is what we call a promissory note. Yo, there's at least two instruments involved with borrowing money. There's two documents you're going to have to sign at closing. One is the promissory note, which, y'all, that's the loan. That's the one that says, I promise to pay this money back under the whatever terms and conditions you agreed to. But in addition to the promissory note, you will also have to sign a mortgage. The mortgage is the lien. Y'all, that's the security. You're basically saying, if I don't pay back like I promised to in the promissory note, then by signing the mortgage, you can take the house, sell it, and get your money back that way. So what is the mortgage? It's a lien. It is not the loan. Y'all, I'm telling you, if you're thinking loan, when they ask you a question about a mortgage, you're going to come up with the wrong answer. And they know what wrong answer you'll be thinking, so they'll make sure they have that there, so you'll feel real good about missing that one. Yep, I came up with the same wrong answer they did. Woohoo! Yeah, but it's still wrong. All right. So what is a mortgage? It's a lien. Well, who's giving the lien to who? Y'all, the borrower's agreeing to give the mortgage to the lender. Y'all, the lender agrees to give the borrower the loan, and in exchange, the borrower gives the mortgage back to the lender. So who's doing the giving when it comes to the mortgage? The borrower. So the borrower is the OR, y'all, the mortgagor. The lender is the mortgagee. Y'all, just most people get that backwards. totally get it backwards. So just be aware. Y'all have done all I can do to help you with that one. All right, so y'all, let's talk about some of these provisions, y'all, common, typical provisions you see in most mortgages. Y'all, the first thing it says here, it must contain all the essential elements of a contract. Y'all, we're 2 or 3 chapters away from this chapter right now, but y'all, we've got a chapter on contracts. We'll be going through all this. But in that chapter, we're going to talk about what these essential elements are. But what it's saying here, y'all, for a contract to be enforceable, and hopefully anybody signing a contract would want the contract to be enforceable. Well, for it to be enforceable, it must contain what have been identified as essential elements. Y'all, there has to be certain things that are agreed upon in the contract. We'll talk about what those are when we get into that chapter. But all it's saying right here is that a mortgage is a binding, enforceable contract as long as it contains what those essential elements of a valid contract. Y'all, the next thing is saying a mortgage is subject to the statute of frauds. Y'all, we're going to talk more about statute of frauds in the contracts chapter. But for right now, y'all, statute of frauds is a federal law that just says any type of contract that is subject to the statute of frauds, any contract subject to this statute must be in writing to be enforceable. In other words, cannot have a verbal or oral agreement and expect it to be enforceable if what you agreed to is subject to this statute. Y'all, will talk about what types of contracts are subject to the statute in the contracts chapter, but obviously mortgages are one of them. It says mortgages are subject to the statute of frauds, which means everything has to be in writing. So you and the lender can't have some verbal agreement. All right. Obviously, we got to identify who the parties to the mortgage are. It must stipulate, excuse me, I'll be all right. All right. Y'all, the mortgage has to stipulate whether title conveys or not. And y'all, this is determined from state to state. Okay, so depending on what state you're in will also determine which of these 2 theories, financing theories, you operate under. Y'all, one theory could be the lien theory state. Y'all, some states operate under title theory. Y'all, in a lien theory state, y'all, that means title to the property does not pass as security at closing. So what does that mean? Well, if you're in a lien theory state, y'all, state that we operate under this lien theory, then the buyer will get title to the property at closing, not the lender. The buyer or borrower will get title at closing. Now, if you are in a title theory state, then title does pass as security, meaning the lender will take and get title to the property at closing. They will hold and keep title until the borrower has paid all the money back in full. Okay? So the difference is, y'all, you need to remember that. Y'all, lien theory, borrower gets title at closing. If it's in a title theory state, the lender will get and keep the title until the loan's paid off in full. All right. I'll tell you where I live. Just for example, y'all, we'll get into your state specific here in a little bit, or on the back end. But y'all, in South Carolina, which is where I live, y'all, South Carolina is a lien theory state. So when you buy real estate in South Carolina, the borrower will get and keep title to the property at closing. All right. Y'all, then you see the term hypothecation. Y'all, that just looks like a term they might ask you about, doesn't it? Hypothecation. Y'all, this is just a term that says that you're putting the property up as collateral, but without giving up possession. Y'all, all that's saying is this, and this typically will be a provision in the mortgage that says, y'all, because when you sign the lien, y'all, you're putting your house, your property up as collateral, right? But the good news is, while you're making the payments, you can still have possession of the property, meaning you can live there. Y'all, that would suck if you had to make payments on that house for 30 years before you could even move in, right? But hypothecation just means that you are putting the property up as collateral, but you're not giving up possession. I mean, I can live here while I'm making my payments. Assignment. Y'all, this is the right the lender has, if they choose to sell the loan to some other investor or lender. Satisfaction, or y'all sometimes hear it called a satisfaction piece. Basically all they're saying there is, once you have paid your loan in full, that lien is still recorded at the county, at the assessor's office, right? With the tax records and whatnot. There's a lien recorded. There's a mortgage on your property. Well, that mortgage doesn't just disappear. It will stay there until the lender files what we call a satisfaction piece, or satisfaction of mortgage. By filing the satisfaction, that's what removes the lien from the property. Now there's no longer an encumbrance, at least not because of the mortgage lien, okay? Then there's the priority of mortgages. We actually kind of talked about that in an earlier chapter. If you recall, what is a mortgage? Remember it's a lien. And we talked about the priority of liens and why that matters. Because whoever has first priority, if we had to foreclose and sell the property, for example, whoever has first priority, they're going to get paid first. And then if whatever money's left over will go to whoever has second priority, and then third, right on down the line. But how is this priority established? Remember, this should be just a review. But remember, priority is established by the time and date that lien or mortgage was recorded in the public record. It doesn't matter when it was executed. It only matters who recorded it first. Then they get first priority. But who is always the first priority, whether there's anything recorded or not? Again, for review, that's the property tax. Property taxes, they are always first, then everybody else is based on this priority. Okay. Then there's a subordination clause. This is just a provision that would allow, say you got a lender with first priority, another lender might come in and request the first lender to agree to subordinate. Would you be willing to subordinate? Let us take first priority, and then you just fall in line behind us. There's a subordination clause that would allow lenders to do that. And I know, and I get all the time, but why would any lender agree to give up their priority? If I have first priority, I'm not giving it up. Well, yeah, you would. Depending on the circumstances. But let's say you initially loaned them, again, $300,000, but they've been there for a long time and really don't owe that much. Say they've only got $30,000 or $40,000 left on the loan. But they decide to go take out a home equity line of credit. Maybe they want to put a pool in their yard. So they take out a home equity line of credit, an open-end mortgage, which is a second lien. But they're requesting $100,000 to do what they want to do there. Well, that $100,000 loan, at least now, is a lot more money than the $30,000 they still owe on their first loan. Right? So the second lender would like to have first priority because they have the higher risk. They're loaning more money than what's currently owed. So they might ask that first lender, since you're only owed $30,000, will you allow us to take your place on the priority list, and you fall in behind us. And they'll do that typically because if the lender were to say no, which they could, if they were to say no, we're not going to subordinate, then what that homeowner is going to do, they say, all right, well, fine. Then we'll just refinance, pay you off completely, and get you out of the way. And we'll just refinance, say, $130,000. So we'll have just one loan for $130,000, right? Lenders don't want you, the last thing that any lender wants you to do is pay off the loan. They hope you never pay it off. If you pay off the loan, they're no longer making any money, right? So, they don't consider you to be any risk at this point in time. You've already paid off $270,000. There's no reason you won't pay off the remaining $30,000. So, we'd be willing to just subordinate. The last thing we want you to do is pay us off. Anyway, that's the subordination clause. Then there's a provision dealing with non-recourse. That's dealing with default of the buyer. But basically what this non-recourse is saying, buyer, as long as you make your payments, everything's good. You pay, you stay. But you quit paying, pack your bags, because you're going to get put out of here. That's all they're talking about there. And then here's that OR and EE we talked about here a few minutes ago. The mortgagor and the mortgagee, which we know the mortgagor is the borrower. But there are things the borrower covenants, covenant is another word for promise. So things the borrower promises to do when they borrow the money. One, you promise to pay your property taxes. You promise to pay your homeowner's insurance. And I will tell you, again, as we talked about earlier, for most people, that those taxes and insurance are going to be included in your house payment each month, right? So you're going to be paying that to the bank anyway to be put in your escrow account. You promise to protect against removal. Basically meaning you promise not to get drunk playing poker one night in the garage and put the title to your house on the poker table. Don't do stuff like that. You promise not to do it. You promise to keep the property in good repair. When things break, you're required to fix it. You got to maintain that property. Now, could the lender at some point in the future decide to just show up on your doorstep and say, surprise, we're here to inspect? Could they do that? And if they find things that are not being maintained, there are things that are broken and you're not repairing, you're not maintaining the property. First of all, can a lender do that? Yes. If you look at number 5, you must allow the mortgagee, which is the lender, the right of reentry. So you got to let them in if they decide to do that. That's a big deal right there. All right. Then here's that prepayment penalty provision. We talked about this earlier. A lot of loans will have a prepayment penalty, meaning you pay your loan off early, then you're going to have to pay a penalty. And again, it's a very expensive penalty. But the main thing I pay attention to right here, actually, we're going to talk more about this here in a little bit, but remember we said, most of the government loans, FHA, VA, lenders can't charge a prepayment penalty on those loans. A lot of conventional loans, they can. Then there's the defeasance clause. All that's just provision that just says or requires for the lender that once you've received the full amount of payment, the loan's been paid off in full, then lender, you must file a satisfaction of mortgage and remove the lien from the property. And then the last of these provisions is this acceleration clause. They could refer to this provision, again, in one of 3 names. Sometimes it's called acceleration clause, could be a due on sale clause, or it could be an alienation clause. But this is a provision that says that nobody else can make payments on your behalf. You must stay here, you must live here, and you must continue making these payments. And if any of that changes, that puts you in default, and the lender could foreclose at that point. Now again, for review, we talked about a particular type of loan here earlier, that if this clause, the due on sale clause, if it is in the mortgage, what type of loan would not be an option? And hopefully you said the wraparound mortgage.